Today we're going to speak about one of the companies that best reflects the type of information that we want to share from Tenvalue. This is Atalaya Mining, a European mining company focused on copper extraction and listed on the main market of the London Stock Exchange. It currently produces around 50,000 tons annually, and its production is expected to increase by more than double by 2030.
There is a significant gap between price and value. Once the company achieves its production target of over 100,000 tons of copper and copper equivalent within the next 5 years, assuming a copper price of $4.25 per pound and an all-in sustaining cost of $2.75 per pound, it is expected to generate 330 million euros in EBITDA. Applying a terminal multiple of 6 times EBITDA and subtracting the capital expenditures required to reach that capacity, that is 2 billion minus 400 million euros, we arrive at a valuation of 1.6 billion euros, approximately over 2 times the current capitalization. By multiplying the average valuation of competitors by the expected copper production of 100,000 tons and subtracting the necessary capital expenditures, that is again 2 billion minus 400 million, we also arrive at the same valuation. Let me walk you through the company's main assets. First, we have the Rio Tinto district, which is 100% owned by the company. It is located in the province of Huelva in southern Spain. Within this district, there are several pits. Cerro Colorado, an operating open-pit mine that produces approximately 50,000 tons annually. The company secured necessary permits back in 2014-2015. In terms of growth potential, the company has significant upside. That is, additional resources located just adjacent to Cerro Colorado, its San Dionisio and San Antonio deposits. These deposits have higher ore grades and are expected to collectively double current annual production. San Dionisio is an open pit and underground deposit currently undergoing the permitting process, which is expected to successfully conclude in 2025. San Antonio, on the other hand, is an underground deposit that is already in the development stage with an infill and expansion drilling program expected to begin in the coming months. Beyond these areas, Atalaya also owns the Masa Valverde project with permits granted and Rio Tinto East, a project currently in the exploration phase. Their second key asset is Touro. The Touro mine is a brownfield project located in Galicia and operated under the Cobre San Rafael entity. In the medium term, the project is expected to benefit from the recent classification as a strategic industrial project by local authorities. The situation is very favorable, with permitting decisions estimated to be completed within the next 12 months. In 2017, Atalaya exercised an option to acquire a 10% stake in Cobre San Rafael, with a possibility of reaching an 80% stake upon meeting certain development milestones. Atalaya Mining is optimistic about obtaining all the necessary permits, given that it has been classified as a strategic industrial project by local authorities. Based on current assumption, Touro is expected to generate an IRR of over 20%, assuming a copper price of $4 per pound. As illustrated in the accompanying chart, Atalaya's all-in sustaining costs are roughly in line with the industry average. We expect both Touro and San Dionisio to come in significantly below that, around $2 per pound. Atalaya Mining has prioritized San Dionisio because its resources grades are twice as high as current ones. The all-in sustaining cost is estimated to be around $2.50 per pound once the company reaches a production level of 120,000 tons.
Regarding the copper markets, global demand has increased steadily over the last century at an annual rate of around 2.5% for the last 40 years, and growth is expected to accelerate for the next years due to the decarbonization of the economy. On the supply side, operating mines are already facing declining ore quality, which is a serious problem in developing mining areas, as increased capital investments are necessary to replace or upgrade outdated infrastructure or processing facilities. Market consensus is that by 2030 there will be a deficit in the market of between 5 to 6 million tons per annum, and this figure is very high, taking into account that the production annually stands at only 22.44 million tons. We're not seeing enough new projects to supply all that demand. Time is also a very critical factor, as it typically takes between 6 to 7 years to operate a new mine once the feasibility study is available, while without one it takes between 17 to 20 years. Even at prices of $4 per pound in 2021, no major projects were announced. We believe that copper prices will rise, and this will happen at a very opportune time for Atalaya mining when new production arrives. Since 2014, the company has built a team with extensive experience in the sector focused on value creation. Alberto Lavandeira is a mining engineer with over 40 years of experience in mining. He has participated in mine construction in various jurisdictions internationally. Cesar Sanchez, CFO, he holds a degree in business administration and is an auditor. Before joining Atalaya, he held similar positions in different financial and mining companies. Enrique Delgado, mining director, was a CEO at Tarsis Mining and director of metallurgy and environment at Cobre Las Cruces, First Quantum.
In conclusion, this is a very good business with an excellent management team, and we believe the price does not reflect the company's true value. A third way to analyze the company's value is the significant discount to NPV. According to the company's latest updated NPV figure, based on the 2023 Rio Tinto Preliminary Economic Assessment and Total Profitability Study, which stands at $1,832 million, it is more than twice the current market capitalization. We hope you find this information interesting. You can view our executive summary and Excel spreadsheet on our website.